If you listen to traditional financial gurus, they're going to tell you to buy term life insurance because it's cheap and that index universal life or IUL is a high fee scam. But if you talk to wealth managers, they'll claim that an IUL is the ultimate tax free retirement weapon. So today, what we're going to do is we're going to put both of those options under a microscope, take a look at the raw data to figure out which one actually gives you the most benefit for your dollar. All right, let's start with term. Simple concept. You pay a small, flat premium for a set period, say 30 years. If you die, your family gets paid a usually tax free death benefit. However, if you live one day past year 31, your policy could expire, or you could find yourself in a situation where the premiums really skyrocket. The value of the policy, if it expires, it drops to zero. No cash value in a term policy. Every single dollar you paid over the 3 decades is gone forever. But term does have its place. We'll discuss that momentarily. Now, at the point where your term policy expires, let's say you go through 30 years of a term policy and it expires, you don't have any other kind of insurance. Well, at that point, you're probably going to need some insurance. You'll be in your 50s, your 60s. And at that point, trying to get a new policy means facing an exponential spike in premium cost due to your age, your health at that point. You know, we all run into health issues at some point in life. So, term insurance, while inexpensive in terms of the premium today, it could leave you completely exposed later on in life. All right, now let's take a look at permanent insurance, specifically the Index Universal Life Policy or IUL. It's a form of permanent insurance. A lot of the critics are going to complain about the fees, and under the microscope, those fees are a concern. Those critics have a point at first. And IUL's fees form a U-shaped curve. So in the first 10 years, the fees are high, sometimes eating 2 to 4% annually to pay for the setup cost. But once you look out into decade two, and you can do that on an insurance illustration, those setup fees drop to zero and your money compounds almost entirely fee free. Okay, so the cost of insurance does rise in decade three, but over a 30-year period, the average annual fee drag stabilizes at roughly 1%. Now, there's also a data point that the financial experts and gurus typically ignore, and that's tax drag. So, if you look at the actual math over 30 years, it starts to make more sense financially. And when we talk about insurance, insurance is a long term play. Insurance is not like trading stocks, which it requires more of a short term mentality. Insurance is something you get into for the long term. So looking at it over the course of 30 years is highly appropriate. On a properly structured wealth building policy for an IUL, you might pay $75,000 in total internal insurance fees, depending on the overall benefit of the policy. But hold on here, because $75,000 is a lot of money. But think about it like this: 75 grand. If you were to put that exact same amount into a traditional taxable brokerage, the capital gains and dividends taxes over 30 years, you're not going to believe this. They're going to strip away an estimated $250,000 or more. And that's at today's tax rates. We as a country, we owe $40 trillion in national debt. Do you think taxes are going to be higher in the future or lower? So just today, we're talking an extreme amount of money, 75 grand, okay, into a traditional brokerage account. those capital gains and the appreciation of that is going to hit you really hard just based on today's tax regime. So, the microscope, our economic microscope, reveals a pretty simple truth. An IUL trades a smaller fee to the insurance company to completely avoid a massive tax bill from the IRS. All right, so what's our verdict? Term insurance is not an investment, it's a temporary expense. And this could be very useful when you are younger, when you are not making as much money, you just bought the house, you just had the kid, you're trying to basically ensure your future wealth. Okay, protect the family, make sure that whatever happens, the family will be able to continue with the goals that you all have set forth. So if you just want inexpensive protection for a few years, then term is appropriate. But if you're trying to build long term, multi generational wealth, don't confuse an upfront setup fee with a bad deal. Over 30 years, protecting your dollars from the IRS is actually the highest return on investment you can get. Now, is there a place for both of these scenarios to work in conjunction? Absolutely. You may find that what you want to do is, since an IUL is going to be more expensive in terms of premium cost, you want to have some coverage there in order to start to get the advantages of building a bucket of tax-free income. But you say, hey, I've got $500,000 worth of obligations with my house and with my car, my student loans, and all that stuff. And I want my family to be protected. So then you may have a configuration where you have a portion of your insurance coverage is term because it's more affordable, and then a portion that is IUL, for example. Now, here's the beauty of it. In most term policies are what you call convertible. So at points within the term, you will have the option of taking a portion of the term coverage and converting it into, say, an IUL. So, as an example, you got $500,000 worth of term insurance. That's your benefit, right? So, as your financial situation gets better and better, you can take, say, $100,000 off of the term, convert it into IUL coverage, and then maintain $400,000 worth of term insurance. Okay. So in following such a configuration, you can make sure that you are getting the benefits, more and more of the benefits of an IUL, but also maintaining the affordability of term and making sure all bases are covered.